This is the third quarter update for the Hennessy Japan Fund. I'm speaking with portfolio manager Masa Takeda. Masa, you've been running the Hennessy Japan Fund for 17 years. Has anything changed over your tenure as it relates to valuing Japanese equities?
Well, yes. So Japanese companies today are much more focused on return on equity, and that's really a big change. The Japanese government introduced Stewardship Code and Corporate Governance Code back in 2014 and 2015, respectively. And that was really an inflection point. With the improvement in corporate governance, Japan's ROE has also improved from less than 5% just 10 years ago to close to 10%. And that's not the end of the story. With the way things are going, I wouldn't be surprised to see Japan's ROE exceeding 10%, maybe to low teens or mid-teens, possibly higher. And so I do believe that Japanese stocks can be valued according to the ROEs of their businesses. And that's a good thing for us because that's how we have been approaching investing for many, many years. And the thing is, that has not been fully reflected in stock markets valuation. There hasn't been any multiple expansion over the last 7-8 years. There are so many companies that are trading at price to book ratio of less than 1 time. So I think it's a great time to be investing in Japan.
So then this is a great follow-up question. With the yen depreciating, how has that affected your portfolio making decision in that process?
So there's no changes to our investment decision-making process. I mean, Japan is an economy with a deep domestic consumption market, but at the same time, it is an export-driven economy. There are some of the finest world-class companies out there in Japan, be it factory automation, semiconductor equipment, specialty chemical, or consumer products. And these companies, despite the ongoing fear of potential recession overseas, they have the ability to grow thanks to their differentiated business models and competitive strength. So those are the kinds of companies that we want to be invested in our portfolio. And even when the yen reverses its course, even if the yen strengthens, again, because of their competitive strength, we do believe that they have the ability to overcome and continue growing.
So Masa, tourism is so important to Japan. What is the state of tourism today?
I'm actually very bullish, very positive on the outlook of Japan's inbound tourism. So just to give you some numbers, 2019 was the previous peak. We had about 30 million tourists visiting Japan. And that was a big jump from just 10 years ago, was less than 10 million. And each tourist was at the time spending around $1,200 to $1,500 US dollars. Now, that went to zero during the recent global health challenges. But we're talking about GDP contribution of about 1%, 2019, and that went to zero. Now it's recovering sharply. And we do think that, just getting back to 30 million people, again, isn't the end of it. If you look at other countries like Spain, I believe they receive about 80 million, France, 90 million. In Asia, Thailand does about 40 million. And so there's still room for growth. And in addition to that, because of the yen depreciation, the yen has weakened by about 30% since 2019. So the same amount of dollars can give you 30% more purchasing power. And I wouldn't be surprised to see inbound tourists upping their traveling budgets to take advantage of this. So, we have a company in our portfolio that's a hidden beneficiary of this trend. So it is a bright spot in the economy.
So as you look to 2024, and we're recording this in October of 2023, what do you believe will be the drivers of Japanese equities next year?
So it will continue to be the improvement in corporate governance, for one. I mean, just the last, 7-8 years, we've been seeing government initiatives. Tokyo Stock Exchange recently releasing statement urging companies, with price-to-book ratios of less than 1 time to take some corrective measures. That's unheard of. Warren Buffett's surprise visit to Japan, that was also a big catalyst this past spring. And all these US activist firms making their way to Japan. So corporate governance is one thing. And then also resilient economy, domestic economy. I just mentioned inbound tourism, but also domestic capital spending is another key driver. Japan has been emerging as sort of geopolitically neutral country. Warren Buffett says something like he feels more comfortable investing in Japan than investing in Taiwan. And we've been seeing in the last several years, companies like TSMC, the world's biggest chip maker, or Micron of the US, they're making heavy investments in Japan to expand the capacity or setting up a new factory. Rapidus is another case where it's a Japanese company, newly founded by a consortium of Japanese leading companies, and they're going to focus on 2 nanometer semiconductor technology. And so there's, collectively tens of billions of dollars in capital spending. There will be a lot of capital equipment manufacturers, suppliers, raw material providers that are also making heavy investments as well. So that's a big growth driver of GDP. And hopefully that will also bring inflation to Japan, because inflation is a good thing in Japan, unlike other parts of the world. And I think that this trend should solidify the end of deflation, which Japan has been suffering for the last 2 decades.
Masa, let's dig into the Hennessy Japan Fund. In the third quarter, which stocks drove performance?
So I give you 2 names. One is Roto Pharmaceutical. We've been owning it for, since 2007. So we are long-term shareholders. And it's a mid-sized company focusing on personal care goods, specializing in OTC eye drop and skincare cosmetics. In Japan, we have this unique eye care culture, if you'd like. People routinely use their eye drops to freshen up or ease eye fatigue. And so that culture is slowly spreading to other parts of Asia. And also skincare cosmetics, they are particularly strong in the area of functional cosmetics, so anti-aging, skincare, etc. And that has been very popular with not just domestic consumers, but also international tourists. I also like the fact that Japan, Roto, has an owner-operator structure. It's led by the 4th generation leader from the founding family. So that's Roto. The other stock is MUFG, Mitsubishi UFJ Financial Group, the largest banking group in Japan. And they are considered the pure beneficiary of potential rate hikes in Japan. So, by total assets, they are the largest in Japan, but also one of the largest in the world. They have about $3 trillion in total assets, and that's about 80% of JP Morgan, for example. Nevertheless, return on assets is only 30 basis points. The reason is about 1/5 of their total assets is sitting in Bank of Japan's account deposits that's earning currently zero interest and partially even negative interest. So imagine, part of that being redeployed to, JGB markets or, lending. Potential operating leverage can be significant because this is a bank that has been generating historical high earnings in the last 2 years, despite the extremely challenging business environment. And so MUFG, we are very positive about the outlook. And even if our expectations for higher rates turn out to be, sort of false alarm, shareholders of MUFG can expect decent total shareholder return. The payout ratio of 40% plus share buyback. So, investors should be compensated by that.
So, Masa, the index that your fund tracks only has a 2.5% combined allocation to energy and utilities. And in fact, your fund doesn't hold any securities from those sectors. What are your thoughts around those sectors today in Japan?
Well, so we actually have some exposure to energy through another name, and it's called Mitsubishi Corporation. So it's a general trading house, and it's gotten famous because Warren Buffett of Berkshire Hathaway recently reported that they have become the biggest shareholder. And we've been actually invested in Mitsubishi Corporation for around 15 years now. And they are one of the major suppliers of natural gas. And also they are one of the largest global suppliers of metallurgical coal. And so we do have exposure to that. And Mitsubishi Corporation is unique in the sense that their balance sheet is really a collection of various operating businesses and operating assets, as well as investment securities. In terms of utilities, it's a regulated industry. And I think the basic premise of utilities business is that the government implicitly guarantees that you will make above cost of capital returns. In exchange for that, you are obligated to invest in long-lived assets, which is a risky proposition. So there's a trade-off. I like regulated industry, but unfortunately in Japan, it's a mature economy. To some extent, it's even declining domestically, and therefore, utilities business, it's hard to view them as a growth sector. And for that reason, we have very minimal, if any, exposure to those two sectors.
All right. So going to the other side, your largest sectors today are financials with industrials right behind it. What are your thoughts on financials today?
So our financial holdings are pretty broadly diversified. So on one hand, we have general insurance companies. There are 3 of them in our portfolio. And generally, underwriting business, general insurance's underwriting business is largely uncorrelated with the broader economy. And then we have Oryx, as I mentioned earlier, that's a hidden beneficiary of inbound tourism recovery. The reason I say that is because it's a comprehensive financial services provider, as well as investment company. And they have some interesting assets. For example, a Kansai International Airport. That's a one-of-a-kind asset. So they run the airport, the airport operations, and that's a huge beneficiary of international tourist rebound. They also run aircraft leasing business and hotel operations across Japan, and that's why we like the company. And then we have Tokyo Stock Exchange. The name of the stock is Japan Exchange Group. It's the dominant monopoly business, the stock exchange business. We like that profile. And then lastly, MUFG, Mitsubishi UFG Financial Group. And as I highlighted earlier, they are expected to be the pure beneficiary of potential rate hikes down the road. In terms of industrials, I talked about semiconductor equipment earlier, and we're invested in Tokyo Electron. It's one of the 4 largest global semiconductor equipment manufacturers. And without Tokyo Electron, we wouldn't be having advanced semiconductor. And so manufacturing excellence is one of the key competitive strengths of Japanese exporters. That's one of our major holdings in our portfolio today. And the other names also include factory automation. And those are some of the global leaders that we can identify in Japan.
So Masa, as you look back on the third quarter, what new additions did you have to the portfolio?
Yes, so we're quite bullish on the semiconductor space, simply because Japan has some of the world-class companies in the space. And one company called Social Next, we made an investment during the third quarter. So it's a chip design company, recently IPO'd, and back in July, there was a global offering which caused the share price to collapse. And that's when we pounced. And Social Next was created through a merger of chip design divisions of Fujitsu and Panasonic. And today, they're one of the largest players. And what I like about this business is that the market is growing. As Moore's law reaches its limit, the chip design is becoming increasingly important within the semiconductor food chain. And hardware manufacturers, they are getting keen on manufacturing differentiated hardware with differentiated features. And for that, they need custom design chips. And that's where companies like Social Next comes into play. And so the market is expanding, and it's one of the largest players, and we like the valuations.
Well, Masa, let's wrap up with one last stock. What is the investment case for Tokyo Marine?
Yes. So before diving into Tokyo Marine, as I said earlier, we are invested in actually 3 mega insurance groups in Japan. And that's the reason is Japan's general insurance industry is an oligopolistic state. After years and years of consolidation, we only have 3 players left, basically, controlling about 90% of the market. And because of that, they enjoy strong profitability, strong cash flows. The other thing is these insurance companies, they're sitting on huge unrealized gains on what they call policy shareholdings. So these are shares of their corporate insurance clients that are publicly listed. And those shares were acquired back in the 1960s, and they have become underutilized assets today. And so they're using these assets, selling these assets year after year for shareholder returns, and also fund their overseas growth strategy. And Tokyo Marine is a great example of this because they are the most well-run company of the three. They have the best track record in terms of underwriting business as well as overseas expansion. And Japan is a country of earthquakes and typhoons. So by diversifying into the U.S., it makes perfect sense to lower the risk premium of the business. They report their financials under the Japanese accounting rule that comes with some extra provisioning. If you adjust for that, if you value Tokyo Marine on the same basis as the likes of Chubb, Allianz, or AXA, their stock is trading on 10 times with return on equity of 17% and the 10-year CAGR of 12%. They have been outperforming the global peers. And so that's why we like Tokyo Marine.
Excellent. Masa, thank you so much for coming on and sharing. To learn more about the Hennessy Japan Fund, please visit HennessyFunds.com.